Hey everybody, welcome to Multifamily Investing Strategies for Beginners. For those of you that this is your first time on here, welcome. I do see that we have quite a few other folks that are in the strategic partnering community, as well as some other followers that like to attend these master classes every once in a while. Welcome to everybody. So this should take between an hour and a half. And then we'll go into a Q&A session. There are 3 parts to this. The first part, we are going to talk about finding off-market opportunities as part 1, underwriting the deal part 2, and we'll really just be talking about the assumptions that I have been covering left and right. If you have been watching any of my master classes or following me at all in the last 3 or 4 months, we have pounded underwriting to death. We're going to continue to do it again today. There is a reason for that. And then we're going to go into strategic partnering, how to find that off-market opportunity, underwrite the deal, and then get paid for that opportunity. And how we do that is through strategic partnering. So we'll cover that. Okay, so hang with me. We're going to have fun. And I'm going to get going if there's no questions. Shouldn't be. We haven't even started yet. All right. So real quick disclaimer. I am not an attorney nor a CPA. I do not play one on TV or in real life. So real or imaginary life. This material is for educational purposes only and should not be considered advice. Consult your own attorney and or CPA for such advice. There's the disclaimer. Time to move on. All right, what are we going to cover today? Part 1, finding off-market opportunities. And we talked about that already. Underwriting assumptions and strategic partnering. Okay, I already mentioned that. So who am I? For those of you that don't know who I am, I will spend less than 60 seconds on this. So pay attention. There might be a quiz later. That is my real email address. Jot it down as fast as you can, because like I said, I'm going to go through the slide in less than 60 seconds because this isn't about me. It's about you. So I'm a multifamily investor and strategic consultant. I am a CCIM market analysis instructor. There are over 13,000 CCIMs around the world, and there are only 60 instructors. I happen to be one of them. Pretty proud of that. Obviously, I mean, everything you guys see me do is CCIM. I mean, just look behind my shoulder right there. Talk about vanity. I am on the tech board, the VP for the tech board for CCIM. I'm also on the foundations board, which is the capital raising arm for CCIM. I am the Ward Center Committee Chair next year, which is another education arm of CCIM. I'm the founder of the Strategic Partnering Community. I'm a former syndicator, now passive investor. And I used to own a property management company, which happened to have been the best education I ever received. See, less than 60 seconds. That's enough about me. All right. Multifamily investing strategies. There are a few of them. The one we all know, love, and respect is the buy and hold model, not the 5-year syndicate or flip model. Buy and hold. You buy it, you fix it up a little bit, you hold on to it for long term, 10, 20, 30 years. Legacy type stuff. That's what I consider a buy and hold model. Then we have our 5-year value add flippers, but here lately, they've been more 24-month value add flippers to try and get that value out of the project because there's been a lot of greedy people in the marketplace. Then we have the master lease option method. I'm actually going to be teaching the master lease option method. I think it's in February, if I'm not mistaken. Then we have the wholesale model. Most of you are familiar with wholesaling. That's where you put a property under contract and then you assign the contract. Now, the wholesale method really only works for smaller properties. Same with the master lease option method. When I say smaller properties, I mean under about 20 units. For wholesaling, maybe under about 10 units. The attorneys and the brokers, the sellers, they've all gotten pretty smart these days. And written into the purchase agreements are clauses that really prevent you from assigning the contract if you're not a principal as the assignee. So the principal that put it under contract must also be the assignee of the contract. And so that's how they're protecting larger deals from being wholesaled. Then we have the bird dog method. That is the illegal way to get an acquisition fee. And then we have the strategic partnering method, which is the legal way to get a strategic partnering fee. And that's the one I really want to cover today, because it is the easiest and fastest way to get started. If you don't have the relationship yet, although you're going to have to build relationships, kind of like with wholesalers, you have to have a buyer's list. Well, as a strategic partner, if you're finding off-market opportunities, you need to have a list of relationships with syndicators and sponsors that you can bring that deal to, so that you can get an acquisition fee. And then we'll talk about what to do with that fee when you get it. So the whole key to this is we got to have relationships. So start building relationships now. Carlos, you do this to me every time. Carlos comes in unmuted. I got you muted, Carlos. So if you have a question, make sure you unmute yourself. So start building relationships now. There's an old saying, an old Japanese saying, I think it was Confucius maybe. When was the best time to grow a tree? Well, 20 years ago. When's the second best time? Today. Same with relationships, okay? You must be building relationships on a consistent basis. Technology, nothing is more important than building relationships, all right? So let's talk about our three-part framework. Part one, finding off-market opportunities. I was really good at this as a broker, even as an investor, but I spent more time brokering than I did investing. So I was investing my commissions into the deal as a passive investor. But there was a syndication that we did in Texas where a friend of ours brought the deal to us. So even that one came off market. So finding off market deals, we're going to talk about in this section, influencers, building relationships with influencers, listing exchanges. Yes, LoopNet. So for all of you that have been told by the gurus that you need to stay off of LoopNet, that's total crap. Okay. These boutique brokers have no idea how to sell a commercial property or a multifamily property, and they don't have the relationships to sell it. So the only thing they know to do is put it on LoopNet. Pay attention to that. Okay. We're going to talk about a marketing plan, an offline marketing plan that goes direct to owners. Then we'll talk about an online marketing plan through email marketing sequences direct to owners. And I'm going to show you how to hire a virtual assistant that can do most of this stuff for you, for us busy folks. So if you have a W-2, you have no excuse. Virtual assistants are not that expensive. They're a lot cheaper than you think. Right? So let's start off with influencers. So the influencers are appraisers, and I'm going to just back up here a second. I hit the button a little quick there. They're probably your most important. The very first apartment deal I ever got was a 32 unit here in Mobile, Alabama. Somebody we know, most of us around know the two Tims, if you guys know who I'm talking about. I bet a few of you do. They just purchased that 32 unit very recently for a very large number. I tried talking them out of it, but my voice only goes so far. I was very, very, very intimate with that property. I actually renovated one of the units for the owner so that we could get that thing to sell so she could get out of trouble. So my very first multifamily transaction was a short sale to a doctor that in 2013. That doctor ended up selling to the two Tims about 9 months ago, 10 months ago, I think, maybe a year ago. I saw them. Where did I see them? I saw them at Jake and Gino, and we were talking about it there. And that was October of last year. So I think they closed on it first part of the year. So it's been about a year. But an appraiser brought me that opportunity. They also brought me other opportunities. So appraisers need data. And when you're specializing in a certain industry, if you build relationships with them and let them know, hey, you can come to me. I'm always in the market. I understand the cap rates, rents, things like that. They need that kind of data. So they like to reciprocate just like anybody else does. So what'll happen is they'll call you up one day and say, hey, look, I just got called by a bank. And this is what happened to me on the 32 unit. I just got called by a bank and they need an appraisal but there's no brokers involved. And I know the property's not for sale. I think they're going to be taking that property back from the owner. Maybe you ought to reach out to the owner. And so, of course, then I looked up the ownership information, called her, and was able to help her get out of that situation. But I'd have never known about that if it wasn't for that appraiser. All right. So do not discount appraisers. I consider them the number one group of influencers in our arsenal. Next are lenders. We're getting ready to go into a very interesting part of the market. If you guys haven't been paying attention, we've had 3 straight months of rent declines across the country. Not all markets, but most markets have declined in rents because of affordability. So there are going to be some properties, because I guarantee you the investors that purchase those assets expected rent increases, not rent declines. And so they're going to be in a bit of trouble when that bridge lender wants that loan due. So there may be some opportunities coming up. Lenders are going to be the ones that are going to know about those opportunities. Now, for agency properties, it is required by law, it's a federal law, that any agency property that goes back to the bank must be sold by a broker. So do not discount the brokers, and they will be the last ones on this list, just, because I don't give brokers a whole lot of respect, but we're looking for off-market deals, and brokers aren't in the business to sell to just one person. They want as many people involved as they can. CPAs are next. These owners, they have to have accountants so that they can account for their finances, pay their taxes and different things. And when they're sitting in front of their accountant and they're having that conversation, they start talking about what's going on with them. Hey, do you know anybody looking to purchase? I'm tired of this thing. I've owned it for 10, 15 years. I'm just tired of managing it myself, and blah, 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 right? So if you're building relationships with CPAs, twofold here. One, good chance they could be accredited and could be a potential investor. And the other is you've got the opportunity to be able to get information from them before anybody else does about a potential opportunity from conversations they've had with their clients. Attorneys are another one. The big ones here are your probate attorneys and bankruptcy attorneys. Now, keep in mind that whether it's probate, whether it's bankruptcy, it's got to be approved by a judge. But if you've built relationships with these attorneys, they can reach out to you and say, look, owner passed away, wife passed away 3-4 years ago, kids inherited, they don't want it. Dealing with the courts right now, we're putting together the whole asset group, and they want to sell it. Like what you're doing, would you be interested, so we don't have to hire a broker, go through all the rigmarole? So that's where attorneys can really come in handy. Title agents are another one. They constantly see who's buying, who's selling, and the sellers are building relationships with them because the owners are building relationships with them because a lot of them transact a lot. And so they may know, like if an owner calls up a title company and asks, hey, what would my closing costs be if I sold this apartment complex? And so that title agent then calls you because they've got the relationship with you and says, hey, so-and-so with this apartment complex just called and asked about title fees. I'm thinking they may be willing to sell. So we can get information from them as well. Of course, insurance brokers, especially if there's been a loss, a flood, a fire, some liability issues. Any property can have any number of problems on it, especially older assets. And insurance brokers are some of the first to know when those problems happen. And if the owner has been communicating with their insurance broker, asking them, hey, what real estate brokers do you know? Or have you heard about anybody looking to buy in this area? Blah, 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 blah. Same story with all of these. Insurance brokers are another one that's good to go to. And then finally, real estate brokers at the bottom of the list, because even though they'll tell you that they'll bring you off-market opportunities, they are sending the same email to you that they're sending to their other 300 best clients. Now, caveat to that, if you've closed 2 or 3 transactions with them and you've built a really good relationship with them, then they may come to you first. But you really have to show that you can close, and it's almost like a guaranteed commission for them to give you that kind of service. So real estate brokers are more expensive than they are a help, especially in hot markets like we're in right now. Much better off going through the rest of these influencers, but don't kick the brokers to the curb, because when this market changes, we're going to need them. Like I said, the agency lenders require foreclosures to be sold by brokers. We're going to need those relationships. All right, let's talk about listing exchanges. Everybody's favorite, LoopNet. There's nothing wrong with LoopNet other than it's the most expensive listing exchange on the planet, and everybody hates CoStar. CoStar owns LoopNet. And they haven't updated the program in 10 years because they don't need to. Well, like I said earlier in the introduction, residential brokers that get opportunities, yeah, there you go, Tom, that's exactly right. Residential brokers that get opportunities, they don't have the relationships to sell a 10 unit, 20 unit, 30 unit multifamily property that they may get, because homeowners own investment property, and a homeowner may come to their residential realtor and say, hey, I got this 10 unit apartment complex or this 50 lot mobile home park or 30 site RV park that I want to sell. Are you able to do that? Their pride, heck yeah, I can do that. And then they sign the listing agreement and go, holy crap, how am I going to sell this thing? I don't have these relationships. The only thing they know to do is to go to their broker and ask, and their broker is going to tell them, put it on LoopNet. Okay. As well as Crexy, Catalyst, Commercial Exchange, Brevitas, RealNext Marketplace. And if you're in Texas, Florida, California, and there are 2 other states, and I can't remember which ones they are, you can put it on apartmentbuildings.com or RPR Commercial, which if they put it in the MLS, it is going to end up on RPR Commercial. Okay, those are the listing exchanges that you should be frequenting to find boutique brokers that don't know how to sell these assets. Now, what you have to be careful of is the bird dogs and the scammers have realized anybody can put a listing on a listing exchange, whether the property exists or not. And usually the properties exist, but they're not for sale. Like you'll see the same listing in LoopNet 6 times from 6 different people. They're all bird dogs, every one of them, trying to scam you. You have to weed through and find out which one has the broker, or it could potentially be the owner. But these folks are representing themselves as brokers and owners. They're just trying to scam you. So you have to be careful of that when dealing with these exchanges. The other thing is if you're looking for multifamily experts in a certain market that you want to build a relationship with a broker, you can go to these listing exchanges. I would start with CCIM.com, find a CCIM first, okay? There is no better representation than by a CCIM. Just trust me on that. Okay. If you've exhausted that, then you can start going down and looking in the directories, because each one of these have directories, and search for the ones that are doing multifamily transactions. Okay. And that's how you can find relationships for brokerage inside these listing exchanges. Any questions on the listing exchanges?
Yeah, David. Are these all the same, I want to call it credibility factor, or are there some that are more flaky than others out of this list?
If the broker knows what they're doing, they'll be listed on every one of them, except for apartmentsbuilding.com, because there's only 5 states that they're in. But brokers will put, well, let me rephrase. Most multifamily brokers today aren't using listing exchanges at all, which again is why looking on the listing exchanges and finding opportunities could be more beneficial for you, because the ones that are putting it on there are the ones that don't have the relationships to sell it on their own. Janelle at CCIM.com. So one is not more credible than the other. The two biggest are LoopNet and Crexy at the top. Catalyst is the one that is embedded into probably about 20% of the MLSs across the country in the bigger markets. Commercial Exchange is the front-facing version of Catalyst. Brevitas was touting themselves as the offline, or not offline, the off-market listing exchange. Still trying to figure that one out. I search on Brevitas. I look in Mobile, Alabama, and I find an off-market opportunity. Did I not find that online? How is that not on market? Anyway, they didn't do so well, but so not a lot of people go to Brevitas. RealNext Marketplace. RealNext started as a CRM, commercial real estate CRM. It was called, crap, I used to work for this company and I can't even remember what the old software was called. Anyway, it's an all-in-one solution that has a CRM, a financial modeling tool to a report builder and deal room, and a listing exchange. So RealNext Marketplace is really, really big in Las Vegas and really, really big in Florida and sporadic around the rest of the country, including where they're based in Houston. Again, apartmentsbuilding.com, just in those 5 states, and then RPR Commercial. Anything that goes into the MLS is on RPR Commercial. That answer your question, Michael?
Yeah, thank you.
Yes, sir. Tim, go ahead.
Going back to that off market, I just like you, I'll see a Facebook group that has 20,000. It specializes in multifamily. Everybody that's interested in multifamily is and might be in that group. Mm-hmm. Or your interest has to be multifamily, and they say, okay, here's an off market deal. Well, didn't they just market it to 20,000 targeted people? I mean, the most specific targeted people in the whole United States. 20,000 people that are interested in multifamily. To me, that seems like marketing. That doesn't seem like a pocket listing that's not with no competition. You just now right. in a group that has 20,000 people as your competitors.
Yep, that's exactly right. You hit the nail on the head. JP, do you have a question? You unmuted. Guess not. Go ahead, Rodney. You got to unmute, sir. There you go.
Dave, I just wanted to revisit when you mentioned the CCIM. I might have missed the paragraph that led up to that. Are you saying we can use that website to find brokers in our particular area or in our particular markets?
Correct. CCIM.com. And one of the header menu items is called Find a CCIM. You click on that and you can search by market and you can search by asset specialty.
And as a CCIM participant, how are they receptive to people who might not have been in the industry for quite some time? Do they, is it similar to working with?
No, they're very receptive. They understand people get started somewhere. The ethics inside CCIM are different than the rest of the commercial world. There's a reason they're the #1 commercial real estate organization in the world. Good question, Rodney.
Thank you.
All right, let's keep moving. All right, marketing plan. Okay, this was my exact marketing plan that I did when the last time not last time, because I had a break for a while brokering and then tried brokering one more time and realized that owners were not responding to marketing messages. But in 2018, this is the exact marketing plan that I used to find $560 million in off-market opportunities. Yes, you heard that right. $560 million in off-market opportunities. So pay attention. There might be a quiz later. Technology. So finding owner contact information. How do we do that? I'm just muting a few folks here so we don't have background knowledge. Well, we can use CoStar, we can use Reonomy, Prospect Now, and Land Vision. Out of the 4 of these, and these are the top, they're not limited to just these. You can go to other places to find owner information. These will have phone numbers, email addresses in some cases, owner data, contact data, where the others will just be public information. Prospect Now is the least expensive, but it's probably the worst data because they're not in every market. CoStar and Reonomy are in every market, and they're about the same accuracy rate. Reonomy will be more accurate for public information. CoStar will be more accurate on markets that are greater than 50,000, properties that are above 50 units, and greater than 50,000 population and above 50 units. CoStar will be better than Reonomy. Both have data. Reonomy relies on public record, and then they also have like credit card data and things like that for tracking phone numbers and other contact information. Prospect Now strictly uses, I believe it's Moody's for their data, and I don't know what Land Vision uses. CoStar goes out and actually surveys the marketplace, the whole country, and they have a just thousands of employees that call owners, brokers, appraisers all day long, every day. The problem is they get paid by the amount of data they collect, so there's a bit of conflict of interest on that. So that's why you'll get some raw data that really isn't that good in CoStar. Where CoStar excels is they own apartments.com, and usually if you've got 50 units or more in your assets, you're probably advertising on apartments.com. So CoStar gets to aggregate that data, which is probably the best data there is. I don't know a lot about Land Vision. Land Vision is more dealing with the land itself, but has all the ownership data and certain pieces of information that developers would need that the other 3 do not have. So that's where Land Vision can come in. You've got other software such as Hunter.io. This is a Google extension. I don't know if you guys have used this or not. You can be on a company's website. Like I can go to Blackstone and I can start to run Hunter.io, and Hunter.io will start pulling all of the contact information for all the employees, including executives from Blackstone. That's how that works. It's pretty cool. Does take a little bit of time to aggregate. So it's not a quick process. There's Fiverr, so you can hire a virtual assistant to go out and pull data for you, like a skip tracer, to be able to find the information. So for strategic partnering members, you've got access to all of the contact information for over 500,000 properties across this country. You can always give a market to a skip tracer, let the skip tracer verify that data. Of course, you only pay for the information they find. Again, accuracy is going to be the issue even with skip tracers. Probably the most accurate information will come from title companies. I call them farm reports. So if you're in a market, find a title company in that market, ask if they provide farm reports. If they do, then you can give them the criteria you're looking for, the asset type, the areas. You can do it by zip code. You can do it by city. You can do it by county. You can even do it by unit size if public record looks at unit size inside public record. In Mobile, Alabama, they do not. So that's why Prospect Now is useless in Mobile, Alabama, because I can only look up property by square feet, because in public record, they don't track units. Bit of a pain in the butt. I don't know if you guys have done any analysis in Mobile and have seen that with public record. Or it can be a real big pain in the ass and try to get public record information from Texas, which is a non-disclosure state, which means they don't have to disclose the transaction details. Then it becomes a real big pain in the butt. But that's where title companies can help with farm reports, even skip tracers on places like Fiverr, Upwork, and onlinejobs.ph, which we'll talk about in a little bit. And then, of course, there's the courthouse themselves. Write this down. Matter of fact, here, I'll type it into the chat. netronline.com. Don't go to it right now, but click on that. Save it in your tabs. That is every single county in the United States, and the court records, tax assessor's office, GIS maps. They are all on netronline.com. I just put it in the chat. What companies are good for skip? Prasad, you're just going to have to find somebody good on one of those VA platforms. I don't use skip tracing services. I do hire VAs. I'm in the process of hiring one now. I hired another one 2 weeks ago, but I don't hire them for skip tracing. So public record, if you instead of walking to the courthouse and thumbing through all the records manually, all that stuff, most of it's online now. You can just go to netronline.com. Some of the counties for the clerk of court records will have some kind of subscription model, but it's cheap as hell. When we bought the property in Texas, it was in Gregg County. We did, in order to do our due diligence, we paid, I think it was like, I don't know, $3 a page or $6 a page for the old deed and some other things when we were doing our due diligence for that property in Longview, Texas. So that's a way you can use NET, and we used NETR Online to do that. All right. Then we've got an email service provider. You're going to need an email service provider because, as you'll find out in a minute when I start covering the marketing plan, one of the methods is to email the owners, but we're not just going to send them a simple email that we type up. We are going to do that. But when we do that the first time, we're going to trigger them. And that trigger is going to start an automated email follow-up sequence so that I can move on and keep going in my marketing plan and let my email follow-up sequence follow up with those owners for the next 8 to 10 weeks. That is really the power that brought the $560 million in off-market deals, was that automated email sequence, to include Grant Cardone. Grant Cardone owns a 300 unit here in the Mobile, Alabama MSA, and his assistant reached out to me and asked if I was interested in being on his show, because one of my emails, which the folks in the strategic partnering community get my marketing plan, they see that one of those emails is how to predict future population. Grant was pretty mesmerized by that and wanted to bring me on the show to talk about it. I turned him down, but you know, that was my own silliness. Carlos, did you have a question?
Nope.
Okay, I'm going to mute you. What's the email software? Well, you know, good thing you asked that, Prasad, because that's the next part of the slide. So there's Aweber, which prior to me getting Kartra, Aweber was my favorite. For most people in the multifamily world, they seem to like ActiveCampaign. I don't know why. I think ActiveCampaign sucks myself. That's just me personally. But for whatever reason, I don't know if it's following gurus or whatever it is, ActiveCampaign seems to be the email service provider of choice for the multifamily syndication world. GetResponse is another one. The problem with GetResponse is its deliverability rate really sucks, because GetResponse allows you to upload lists that you could purchase from list brokers. That's actually not good. You shouldn't do that. but get response allows you to do that. So their deliverability is pretty terrible. Notice the two that aren't on here. If I've got real estate brokers and mortgage brokers and insurance agents, the two that they love is MailChimp and Constant Contact. They are two of the worst on the planet. Your deliverability will be absolutely crap. Anything you send through MailChimp or Constant Contact more than likely is going to go to promotion or spam, because everybody knows that those are good for e-blasts. I was on a call earlier today, and I heard a pretty astonishing statistic that his friend who has Constant Contact as their client, he was on the phone with the CEO of Constant Contact, and the CEO told him, this was, I don't know, a month or so ago, the CEO told him that 94% of all emails that come out of Constant Contact are e-blasts, not automated email follow-up sequences, which are the power of these platforms. The key is always, they call it this, they say in sales, the money is in the follow-up, and automated email sequences provide that follow-up. All right. It is the true power of automating your processes. So my favorite is Kartra. I've been with Kartra since they launched in 2018. I'm not going to go anywhere else. I do have a ClickFunnels account, which does not have an email service provider. They actually really suck. I don't even know why I still have the account. And I have a Groove account because the guy that developed Kartra also developed Groove. And I got a really, really, really good deal for a lifetime access to Groove without having to pay monthly payments. So I bought it, and I'm letting it sit until they get all the kinks pulled out of it, and we'll see what it can do in the future. But other than that, my recommendation would either be Aweber, or I would recommend ActiveCampaign, because it's probably pretty easy to find support for ActiveCampaign, because most people in this community are using ActiveCampaign. And then, of course, obviously, I would highly recommend Kartra. So Prasad, hope that answered your question. All right, so the actual marketing plan itself. First contact attempt. Okay, so this is the first time you got your list in front of you. Let's say you went to CoStar, you pulled the list, you got the list in front of you, top name. What are you going to do? Well, first contact attempt, first thing we're going to do is write a prospecting letter to the owner, and we're going to mail it to them. We're not going to wait. Look, you're going to have salespeople that are going to tell you, wait a few days before you call the owner so they see that you got that letter first, and then ask them, did you get my letter? Nothing screams salesperson more than asking, did you get my letter? Okay, don't do that. You want to build relationships with these folks. All right. Just call them. So put on your plan. I had a list when I did this, 30 a day was what I did. So my prospecting list consisted of 30 a day. And here were the 30 I did every day for 5 days. All right. First thing I did was I started with printing my prospecting letters, and I signed each one individually, but I did not handwrite the envelopes. I did that for the first 100. And I never, ever, ever, ever will do that again. Do not handwrite your envelopes. That is just crazy. That is a total waste of time. Then I'd call them. Now, make no mistake. If they do not know who you are, it is a cold call. You're going to have some salespeople that will tell you, or some sales trainers that will say, if they have what you need, if they are in need of what you offer, then that is considered a warm call. That's not true. If they do not know you, it is cold, pure and simple. Okay. Now you can believe me or you can believe them. But when you call and they're like, who are you? Click. Trust me, it was cold, whether they need what you have or not. When you make that call, if you do not reach them, leave a voicemail. Now, this is no joke. I would make the call. And whatever my call script was going to be, and make no mistake, there was a script, that would be the first voicemail I left. When I left that voicemail, I would send an email. And here's the funny thing. that first email, and I learned this from a guy that specializes in email, and it was through Sales Gravy. They're a sales training company owned by what's his name? He wrote Fanatical Prospecting. Anyway, that group, I learned from them that there was a tactic, and it is a tactic that you can use to increase your open rate. And what he did was when he would send an email after, Jeb Blount, thank you, Julie. When you would send an email after leaving a voicemail, the subject line said voicemail. The body of the text said left a voicemail. That's it. Talk about the open loop of all open loops. Okay, an open loop, if you don't know what that means there's no end to the statement, to the question. It leaves you wondering, what voicemail? You left a voicemail. So what are they going to do? If they've read that, they are going to do one of a few things. They're either going to go listen to the voicemail, or they're going to email you and say, well, what'd you say? They're going to delete the email and say, what a stupid tactic. Or they're going to call you and say, hey, I see you left a voicemail. I didn't listen to it. What'd you want? Okay. 3 of the 4 of those are good responses. The only one not is they delete the email. Okay. So it's just a neat trick. All right. So subject line, voicemail, body text, left a voicemail. Only do that with the first contact attempt. Don't continuously do that. It will wear itself out very fast. Okay. Once you send the email, if you do not have that contact in your CRM yet, add them to the CRM and then trigger them. So what you do is you create a list inside the CRM or wherever you have your CRM or whatever. Some will call them tags. Some will call them triggers. It just depends on what service you're using. I think ActiveCampaign calls them triggers. So when you add somebody to that list, it triggers the automated email sequence that you create. Okay. That's what you want to do. As soon as you leave, or as soon as you send that first email, you want to trigger that automated email sequence. Next, you want to connect with them via social media. So take their name, their company, go to LinkedIn, look them up. Go to Facebook, look them up. Go to Twitter, look them up. Try to connect with them on social media. That's all we're doing right now, just connecting, sending a connection request if we can find them. Some you'll find, some you won't. All right. Do not text. First contact attempt, really prior to having a conversation with them, whether that conversation is through email, whether it's through phone, whether it's through Zoom, networking, whatever, never, ever, ever send a text to somebody you've never had a conversation with, ever. It is the fastest way to be excommunicated from their world. You will never do business with them. Do not text to start. You can do text afterwards. Just do not do text to start. Okay, that's the first week. In the first month, I do it once a week for the first 4 weeks. So the next 3 weeks are pretty much the same. Again, try to cold call the owner. If I don't get them, I leave a voicemail. Or if I get a gatekeeper, I give the gatekeeper a message. Then I send an email. Again, not the same voicemail, not the same email. And then this time I send value via social media, and I can now start to attempt to contact via direct message once they've connected with me on social media. So direct message really can take the place of that texting. So once they've connected with you, now you've got the ability to do direct message. Notice that I did not send another letter. We only do the letters once a month. Okay, so speaking of months, now that's the first 4 weeks. After the first 4 weeks, now I go monthly for the next 6 months. If I have not reached them by 6 months, they obviously don't want to hear from me. I will end that campaign and then wait a year or 2 and try it again. So again, mail prospecting letter to owner, not the same letter. Again, cold call the owner, leave voicemail if I don't get a hold of him or her. Send an email, let them know I sent the voicemail, and again, send value through social media and attempt to contact via direct message. Any questions on the marketing plan? "50 minutes into this and we're still in part 1, but it is the most important part." Go ahead, Rodney.
Dave, I'm just curious. Most of these apartment owners, when I think of my apartment owners, I'm thinking of like older people and not really so socially connected to social media. What's your thoughts on that?
Well, then they're not going to be on social media. You're going to have to try to get them by letter, by calling them. If you can get an email address, if they even have email, you can try doing email. But yeah, not everybody is going to be on social media.
Okay.
Nothing you can do about that.
Got it.
Just got to find other ways.
One more question.
Yes, sir.
Okay, so the email address is key, right? But
Yeah.
CoStar or these different list provider services, it's very difficult to get emails out of them. So what's your recommendation as far as, and not to drag out your presentation or anything, just curious to know, how do you combat that?
You can either skip trace it yourself or hire a skip trace.
Okay, got it. Okay.
That's the only way to combat it.
Got it.
Hey, good questions.
Thank you.
All right. All right, email marketing.
Go
ahead.
Hi, Dave. So in terms of the content, like, how do you suggest we structure it for the 1 through 6 letter email service?
You're mumbled, Prasad.
So in terms of the content, right? Like, what do you like? What kind of email content do you suggest in the emails 1 through 6?
You provide value. Every single one of the emails will have a way to contact you. But if you go through the email sequence that I created and is available to all the members in our area, in the membership, you've got, of course, trying to see if they have an opportunity available. Then there's market resources you can send them. There's tax implications and talking about either 1031 exchange or cost segregation, things like that. Doing 3D modeling with renting when COVID was around. Company called Matterport did really, really well with apartment managers during COVID because people wouldn't go view apartments. So they used Matterport and 3D imaging software to tour apartments. So these are all things that owners would be very interested in that would capture their attention. If you pay attention to my market analysis training and how to predict future population, that's probably the most popular email I've ever sent. That one email spurred more responses than anybody else. And I give that email to all our members.
Thanks, Dave.
Yes, sir. All right, CAN Spam Act. What does that actually say? For those that don't know, this is the legislation that controls how we email people. These are the legal rules and regulations, if you will, the SEC of the FTC, because the FTC controls this, Federal Trade Commission. What does that say? What does CAN Spam Act say? Well, it says you can spam. But that doesn't make sense. I've always been told I can't spam. Well, no, the act specifically says you can. So here's the deal. How do you think realtors and mortgage brokers and insurance brokers that you have never heard of before got your email address and sent you a flyer? Is that not spam? Are they not violating the CAN Spam Act? Well, they may not be. If at the bottom of that email there is a way to unsubscribe, and it has their contact information on it, their legal address and their name, doesn't have to have a phone number or an email, but you got to be able to unsubscribe, and it's got to have the contact information, then they're doing it legally. There you go. Thanks, Tom. I learned this about a year ago and it blew my damn mind. I had no idea. I, like everybody else, thought you could not spam. No, you can spam. You just have to abide by the rules. So when you email that owner the first time and you add them, you trigger them to your automated email sequence, even though they didn't ask to get that sequence. If they do not unsubscribe, and you have a way to unsubscribe, and if you have your contact information in the footer of that email or somewhere on the email, you can legally do that. It is a white hat technique, not what I've thought for years to be a gray hat technique. So white hat, gray hat, black hat just means you are allowed to do it. You're in a gray area. You're not allowed to do it. That's white, gray, black. Okay. In the internet marketing world, that we call it white hat, black hat, gray hat. Okay. So yes, you can spam. You just have to do it legally. Okay. And if they ask you to unsubscribe, unsubscribe them. Take them off your list. You do not want to get a complaint. Okay. Like the no call list, it won't be pretty. No call list is worse, but it won't be pretty. So you want to create an automated email follow-up sequence. My sequence right now is, I think it's 9 weeks long. Well, I've got 2 of them in the members area. One is 9 weeks. That's the off market to owner email list. And the other one is to accredited investors. And I think that one's 8 weeks. Okay. So I like to do them weekly because you kind of stay top of mind that way. Now, if I'm selling something, like I told you guys, there'll be an offer at the end of this presentation. You'll get follow-up emails. If you don't take the offer, you'll receive follow-up emails for the next 5 days, every day until Sunday when the offer expires. When I do something like that, it's daily. But when I'm trying to build a relationship with an owner, or if I'm trying to build a relationship with a passive investor or an accredited investor, then I do it weekly. It allows me to stretch it out further, and I don't feel like I'm bothering them. Okay. So you're going to do it as a relationship building campaign. You can do it weekly. Again, 8 weeks, 9 weeks, 10 weeks, could even be 6 weeks. Doesn't matter. You can do monthly. You see these capital companies, syndication companies, they like to do these newsletters where they'll e-blast their whole list, a newsletter that's 2 miles long. I don't recommend that. Nobody should do that. Nobody's reading it. I promise you, nobody's reading it. It should be about that long, as short as possible. If possible, create a YouTube channel and send them to a video that explains everything else that's going on. You'll build better relationship that way than trying to get them to read an email that's a mile long. They're not going to read it. They're just going to delete it. So don't waste your time doing newsletters unless it's extremely short with a link to go to a video. Okay, you've also got the opportunity now, once you get them in the email list, that if you find an opportunity, okay, and you're looking for a syndicator or sponsor to get that off to so that you can either get a strategic partnering fee or maybe co-sponsor, find a KP, something else because you want to take it down yourself, or JV partners if it's a smaller deal, then you've got the opportunity to broadcast that to your database. All right. So that's the power of having an email list. All right. So if you have a job, you're definitely going to want to use a VA. For the rest of us, if we want time freedom, we definitely want to be using a VA. If there's things you don't want to do, like skip tracing, you're going to want to use a VA. So VAs can schedule appointments for you. They can skip trace contact lists. They can mail letters. You know what you want for your letter. Email that to your VA. Let your VA stuff those envelopes. Why should you do it? You can pay for it, or have your VA schedule it with some kind of mailing company that will do that for you. Their names escape me what those companies are called because I'm deep into this, but I think you know what I'm talking about. It's not a clearance house. Anyway, doesn't matter. They can post social media content for you. They can also update website content for you. They can enter data into your CRM. All right. You don't need to do any of this. So the saying in sales is do the work, especially during the golden hours, which is 8 a.m. to 5 p.m. most days. Those are considered golden hours. During the golden hours, you should be in front of your target market, whatever that may be, whether it's accredited investors, whether it's owners, whether it's other syndicators and sponsors, or whether you're selling something to somebody. If you're a broker, if you're in front of owners for listings or investors for buyer agency, or if you're insurance or whoever you target for insurance, whatever you're doing between 8 a.m. and 5 p.m., you should be in front of those people. The more you're in front of them, the more successful you'll be. So if you're entering data in your CRM, or if you're posting social media content, or you're skip tracing contact lists, you're not in front of your prospects. So do the things during the golden hours that will get you what you're worth. So if you have valued yourself in the past, when I was brokering, I had myself at a value early on at $214 an hour. That went up considerably as the years went on, but early on it was $214 an hour. Anything that I was doing that should be paid less than $214 an hour got delegated. So if you can get that mindset and use VAs to be able to do that for you, you can become highly successful in this business. So we can find VAs on Fiverr.com, which is the most popular, Upwork.com, which probably has the best back-end tracking software for time stamping in, out. So for employees or salaried, for salaried or hourly employees, Upwork is one of the better ones because of time tracking. Onlinejobs.ph is in the Philippines, thus the PH, which is probably one of the best ones for English-speaking foreigners. So Fiverr and Upwork, you'll get a lot of India, you'll get a lot of Pakistan, other countries where it's very hard to understand them, where in the Philippines, they're taught English in school, part of the agreement we had with the Philippine government when we occupied 10 military bases. When I was in the military in 1991, when Mount Pinatubo exploded, we moved out. But we still allow Philippine nationals to join our U.S. Navy, and they still teach English in their schools inside the Philippine education system. So the Philippine guy I just hired 2 weeks ago to do website development for me, he speaks as good as English as I do. I was very impressed with his English, but I'll go over the hiring process in just a second. Tim, do you put the unsubscribe in that first email with voice message? You do not have to in that one, Tim, because you're just contacting that person and letting them know. It's not really spam. You're just letting them know you left them a voicemail. On the automated follow-up sequences, absolutely, you have to put that unsubscribe in there. And whatever software you're using, it's going to be automatic anyway. So what you do is the first thing you do with any of these is you post your need. Okay, so you have a job opening. Make sure you are detailed on your job description and what it is you're looking for. One of the things I like to do, and I actually learned to do this from Hunter Thompson. He's the capital raising guru, I think, if you will. He wrote the book Capital Raising for Real Estate. So in the subject line, tell them, put something in the subject line when you respond to this ad that is identifiable. So like the one I'm doing right now, I need somebody that is skilled in Zapier. Zapier is an automation tool that can connect softwares. It's two completely different softwares. The two software that I'm trying to connect do not talk to each other through APIs. Zapier creates those connections for you. I'm having trouble connecting them through Zapier, even though they're both in Zapier. So I'm hiring somebody on onlinejobs.ph to be able to do that for me. So what I told them was, in the very first sentence of the post, in the subject line when you respond, put in quotes Zapier. And the only reason why I'm doing that is because I'm looking for attention to detail. That will kill 90% of the people that respond. So if you get 100 responses, only 10 are going to have Zapier in quotes in the subject line. For the rest, look at their what they say they can do. If they are qualified, move them to the second level. The second level is ask them to create a Loom video. So loom.com, it also has a Google extension, is a free video recording service. You can record your screen or both up to 5 minutes. And it allows you to create a link that you can send to somebody. Customer service representatives use this kind of thing all the time. They use Loom all the time because it's the best way to provide customer service to somebody when they have a problem. So ask them to send a Loom video. The reason you're doing that is you want to look at their communication skills, see how well they speak English, see if they do it in the first place. And again, you're going to weed out another 90% at this point because most of them won't do it. And you want to see what their internet connection is like. And do they have the technology to even be able to service what you're asking them to do? So that Loom video, when you're asking them to explain why they're a good fit, now, as they're explaining that, you can also compare it to what they wrote down in the email response for you. Okay. That will narrow it down to the one-on-one interviews, and then you hire the one or two that you need for the position. Okay. And then all you have to do is rinse and repeat every time you want to do it. I hired somebody like this 2 weeks ago. I'm in the process of hiring another person, this exact strategy. It's worked extremely well. Okay. Any questions on off-market opportunities? I know that took an entire hour to do. It is the longest of the training, but it is also the most important, especially considering I've been pounding underwriting into the ground lately.
Hey, David,
Dave?
can you? Oh, sorry. Go ahead.
Oh, go ahead.
Can you repeat the name of the guy you said that you basing all of these criteria to find the VA? You mentioned a name.
So Hunter Thompson, he's got a $10,000 program called Raise Masters. I had this limiting belief a couple of years ago that because I haven't raised capital since 2018 and I teach raising capital, that I needed to update myself, make sure I was up to speed on current raising capital procedures, if you will. Yeah, you know, what did I learn from it? I did learn about the regulations in fund of funds, and I learned how to hire a VA. That's what I got for 10 grand. I'll take it. I did learn something. But he does not promote the fact that he has a system that will show you how to hire VAs. It's only something you get when you're in his program. That's all it is. Michael, do you have a question?
Yeah, for the email content, are you addressing it to the entity that owns the real estate or to the actual owners or the managers?
The owners, the individuals.
Okay, so you're trying to get their personal email then?
Yes.
Okay, thanks.
But their personal email may be their company email. My primary email is david@davidmonroeccim.com. That is my company email. Nobody knows my personal email. I don't even look at my personal email. I now consider it my spam email. Yeah, roger that, Tom. He's a good marketer. I was at an internet marketing conference in September this year. Him and I were the only two multifamily real estate guys out of the 7,000 people that were at that conference. So we had a good laugh about that. All right. Underwriting won't be as long. The outputs of your market analysis become the inputs of your financial analysis. Let me say that again, because that may have gone over your head. You must do a market analysis in order to do a financial analysis, because the outputs from that market analysis become the inputs for your financial analysis. There are no ways around that, folks. If you're skipping the process of a market analysis to do your financial models and you're accepting the T12, the rent roll, and the OM from the broker, you're going eventually to fail. People have made it recently because of the market, but that market is changing. Okay, we're going to see a lot of failures out of people that have purchased in the last 12 to 24 months. Mark my words. All right, so first, find a model you will use. Don't ask me which one, because I'm going to tell you they all suck. Every one of them, including mine. I built one for myself. It is available to members in the members area if they want it. And I did purchase one from a guy, what's it, Synthesis Analyzer, along with all his training videos on how to use it. But I don't endorse it. I just put it in the members area for our members to use. All the tools suck. The tool doesn't matter. What matters is what you put into the tool. Put good information in, get good information out. Put shit in, get shit out. That's how it works. So if you're only putting T12, rent roll, and OM information into your model, you're going to get garbage on the backside of it. That garbage over the last 3 or 4 years was saved by market conditions, but those market conditions are gone. It is not going to save you moving forward. You need good, solid assumptions to put in those models. And that's what we're going to talk about. So what data do we need? Well, I've said it a few times now. You're going to need a T12 or a profit and loss statement. If it's a smaller property, you're probably not going to get a T12. For those of you that don't know, a T12 is a profit and loss statement broke out over a 12-month period on a monthly basis. So it is considered the trailing 12-month. From that, we can look at trends. We can do a lot of different things. We can extract out a T6, which is a trailing 6-month, and annualize it. And we can extract out a T3, which is what an agency lender is going to do if it's a large enough property, and annualize that. So there are things we can do with that T12 that we can't do with the P&L. Then you're going to normalize the financials. All that means is if you're getting agency debt, you need to do a T3 on the income. And if you're, no matter what you're doing, you got to normalize the expenses. So if management fee isn't in there, you need to put a management fee in there. If depreciation or interest payments are in the operating expenses, you need to pull them out. You will see that. You're going to need to increase, because more than likely the property taxes are going to increase on the property. The lender, I guarantee you, when they do their underwriting, is going to increase the property taxes in year 1. You need to do the same. If you don't know how to do that, you can reverse engineer the tax bill to figure out what it's going to be, or just call the county assessor and ask them, hey, purchase price is this. What's my new tax bill going to look like? They'll tell you, okay? And then you'll also need to adjust your insurance based on your insurance requirements, the requirements of the market, the requirements of that property. More than likely it's going to increase, okay? That's normalizing the financials. You're going to need the rent roll, because we're going to need the unit mix, so that when you go into your financial model, whichever one it is, you can put in, instead of putting the whole rent roll in there, you can just put the unit mix in. There are 31 beds, 62 beds, and 10 3-beds. And then their square footage, their price per foot, and then they're asking rent. Some will even have market rent. Hopefully, if you got a really good rent roll, you can get lease start date, move-in date, lease expiration date. And you can also get balance. So if they've paid, the balance should be 0. If they've overpaid, the balance will be negative. If they owe, the balance will be positive. We don't want to see positive numbers in the balance. That would be a good rent roll. You're not always going to get a good rent roll. Going to need rent comps. So you're going to have to go into a supply side tool, like CoStar, like Reese, Axiometrics, Yardi Matrix. These are all supply side tools that, even Land Vision, that will allow you to be able to draw areas for your direct competition so you can find those rent comps, because there's information from those rent comps we have to be able to extract out. We call that a trade area, the direct competition of an area. It's an oversized neighborhood. And in the underwriting workshop that I'm doing right now in the members area, we just talked about exactly how to draw those trade areas. I went into CoStar and I showed everybody how to draw those trade areas. You do not do a 1 mile ring. That will screw you. You do not do a zip code or any other thing when dealing with multifamily, because you can end up crossing barriers that will screw you. You don't want to do that. Could you please repeat the sites you just said are rent comps? Okay, so CoStar, Tom, Reese, REIS, CCIM now controls individual subscriptions to Reese. Reese now only themselves, which is now Moody's, they only sell to enterprise companies, but you could still buy individual subscriptions through CCIM. Axiometrics, they're not in every market, but they are a good source. They're really expensive. And then Yardi Matrix. Yardi is a property management software that also provides analytics. They're pretty good. The problem with Reese, Axiometrics, and Yardi Matrix is they're only in the top 135 markets, and there are 396 markets. So they're only in 1/3 of the markets, and they only cover 50 plus units. Anything under 50 units, you won't get data for. Where CoStar, you get data for every market and all unit sizes. So finally, we want to identify the underwriting assumptions. So what are they? First is projected or market rents. So this depends on how you look at it. When you look at a T12, the T12 may or may not have potential rental income at the top. What does that mean? Well, there's two ways to look at it. One could be what the market says the rents are going to be. There are some management companies that will do that. The other could be the max rent they're getting for the specific floor plan, averaged out for the whole property. That would be your potential rental income. If you have potential rental income, then you must have loss to lease. Okay, that gets you to your rentable income. The market rents are what we're looking at here. So when you are assuming market rents, when you are in your financial model, what data are you using to look at that? If you go to CoStar and you pull a trade area and it's a proper trade area, you've done the right things, CoStar will tell you what the market rent is for that age, for that asset class, so class A, B, C, and for the area it's in. It will tell you what the market rent is. If that's the number you're using, fine, you have data to back it up. Okay, that are not what the broker says in the OM. I can't tell you how many people will put what the broker says in the OM are the projected market rents. Keep in mind, the broker has a specific job. Get the most money they possibly can for the seller, which means they make the most money in commission. They don't represent you, they represent the seller. So when they pull their rent comps, they are going to go outside that trade area to find the best rent comps there are, so you can drive that number up. Do not trust it, ever. Okay, next is vacancy. It may be 100% occupied. I guarantee you the lender is going to say, nope, not going for 100% occupied. Okay, so what does that mean? That means you've got to go again to CoStar or one of the other reports, look at the history of the property. So you'll have a long-term occupancy average. CoStar goes all the way back to the year 2000. So I can look at the long-term occupancy average, and CoStar will tell me what that long-term occupancy average is. Lenders like that number. If that number is less than 5%, the lenders no longer like that number. Their minimum is 5%. But if that long-term occupancy average says the vacancy is 8%, the lenders like that number. They will use 8%. Okay. Then you've got to factor in credit loss. So late rent, no pay, people getting evicted, things like that. That's your credit loss, your no payers. Since COVID, the magic number, depending on the lender, has been 2% to 3%. I'm surprised it's not a little more than that. So if you're at 8% physical vacancy, you got to add another 2 to 3% for credit loss. You can't get around it. The lender's going to do it. The lenders, he who has the gold controls the purse, right? So do what the lender says. I always underwrite to the lender. So you want to add, so you're actually ending up at economic vacancy, not just physical vacancy. Hope that makes sense. Next is income growth. Here's where everybody screws up. Oh man, 2021, it was 21% or it was 18%. So I'm going to be conservative and I'm only going to go 8%. And they just throw a number on the board. Makes no damn sense whatsoever. Okay. When you look at the 22-year history that CoStar will show you, it actually shows you what the income growth is in percentage for every year. Most markets that I've seen in the last 12 months seem to average about 3 or 4%. Most of them never went above 8% until 2021. 2021 was an anomaly year, yet all these investors are utilizing that to fudge their numbers. Now, here's the whole thing of it. I don't care if you use 8%. I don't care if you use 20%. You're going to do the same thing for expense growth. Now, the kicker is they'll do income growth at 8%, and then they'll do expense growth at 2%. What do you think that does to your model? It makes the frickin' arrow go up and to the right. Duh. Your NOI has nothing but growth because I only have 2% expense growth, but my income's growing by 8%. So my income's outgrowing my expenses 3 to 1, 4 to 1. In what world does that make sense? In a 7 to 8% inflationary environment. And if you look at real numbers, if you talk to the syndicators out there that will actually talk to you that have been operating properties, most of them have not operated less than double-digit expense growth in the last 2 years, if they're being honest about it. Okay. But here's the way around it. I don't care what you put for income growth. Make it the same for expense growth. Now you're not manipulating the model. So if you use 3% for income, use 3% for expense. If you want to use 20% for income, use 20% for expense. It doesn't matter. You're not manipulating the model. Okay. Any other way, you're manipulating the model because it's just a guess. We cannot be that good at this business that we can guess what our expense growth is going to be in 3 years. I can promise you that. Okay, your loan, especially today, interest rates have doubled. Now they've come back down some. Freddie's down 3/4 of a point, so 75 basis points in the last 3 or 4 weeks. We've got inflation that came out today and the Fed minutes tomorrow. So we'll have a raise tomorrow, 50, 75 basis points. Who knows? We'll see. I don't think it matters either way. I think the stock market cares more than anybody else. But you got to pay attention to your loan assumptions. And then if you're going to refi, what rate are you looking to refi at? Now, the rule of thumb over the last several years has been 10 basis points per year increase from your going in cap rate to your exit cap rate. Well, there's already a problem with that. First of all, the lender doesn't look at your going in cap rate. They could care less what it is. They look at the market cap rate. And they want to see that increase, that 50 basis points, if it's a 5-year hold, from the market cap, not the going in cap, because the going in cap has been way lower than the market cap on most acquisitions over the last 3 or 4 years. Well, when you look at your loan right now, if your interest rate's at 6% and it's going to be 6.5 right now, your cap rate, your going in cap rate, in order to have positive leverage, which means in order for that leverage to mean anything to you, we use loans for leverage, right? It allows us to be able to increase our return on the property because we don't have to pay cash for it. Well, you lose that ability when your cap rate is lower than your interest rate on the loan. They call that negative leverage. You're actually better off and get a better return paying cash for the property than getting a loan on it. All right. So you need to be very careful with your loan and your refi assumptions. And then, of course, your exit cap rate. Are we going to continue in an inflationary environment? Are the rates going to continue to go up? And if they are, what's it going to look like 3, 4, 5, 6 years? My opinion, and only my opinion, I do have some data to back this up, is that once this all settles in the next year or two, we are going to settle between 6 and 8% interest. Because if you look at the last 40 to 50 years, interest rates are between 6 and 8%. When there's a major event in a market and they lower rates to try to squash it, that's when rates go down. Rates always come back up to between 6 and 8%. I don't think it'll be at the high end. I think it'll be closer to the low end. So maybe 6.5%, 7%, but between 6 and 7 is probably more appropriate. But historically, they're between 6 and 8% on a historical basis. Okay. So be careful with that exit cap rate, knowing that the cap rate must be higher than the interest rate on the loan in order for somebody to make sense to purchase that property. So if interest rates are at 6, that means your cap is going to have to be higher than a 6 in order to get a buyer. Okay. How do we test our underwriting? Well, we can use the operating expense ratio, right? For newly built, brand spanking new, delivered today, fully leased up by Greystar. Greystar is the #1 owner in the world. They own over 200,000 units. There's nobody anywhere close to them. They own and manage over 200,000 units. The closest one to them is at like 60 or 70,000, #2. Okay. They have a hard time operating at 35% operating expense ratio, brand spanking new, delivered. Now, I see all the time 1970s, 1960s, 1950s, even 1980s product where the syndicator says at stabilization, we're going to be at 32% operating expense ratio. In what fantasy world are you living in? Nice try, but that is a test. So if your operating expense ratio at stabilization for new built is at 35, for older properties between 45 and 55, then that's a good test that your underwriting probably is going to make it. Now, caveats: in high rent markets like San Francisco, Los Angeles, New York City, Miami, this does not apply. So if your rents are $4,000 or $5,000 a month, you're going to have much lower operating expense ratios. Okay. They're anomalies. It ain't going to happen. Yeah. Isn't that right, Tim? Okay. Smaller properties, same thing, because you don't have economies of scale on them. You got a 10 unit, your operating expense ratios are going to be lower on a 10 unit because you don't have as many roofs. You don't have as many hot water heaters. You don't have as many HVAC units. So your operating expense ratios are going to be lower on smaller properties. So those two caveats to what I just talked about. Next test is your debt service coverage ratio versus your LTV, loan to value. Okay. So what does that mean? Well, the minimum of loan to value or debt service coverage ratio, whichever is lower, is what you're going to get a loan on. So when all these syndicators are saying, the lenders aren't going greater than 55% right now LTV because of risk in the market, it ain't got nothing to do with risk. You're the risk. You're underwriting. That's the risk. If your debt service coverage ratio met the minimum somewhere between 1.2 and 1.4, depending on the borrower, depending on the property, depending on the market, depending on the location, that's all risk to the lender. It'll be somewhere between 1.2 and 1.4. That means that your net operating income is 20% to 40% greater than your annual debt service on the loan they'll give you. So there's a way to reverse engineer that you can do through the mortgage constant that we're not going to get into that math. but the lender will determine your loan amount based on whether you meet the minimum DSCR in year one or loan to value. Okay. So if you can meet the minimum DSCR, they'll give you 75% loan to value, not 55%, but you must be cash flowing. The reason these investors aren't getting 75%, they're only getting 55%, is because the property's so far overpriced that they don't meet the debt service coverage ratio in year one. So they're only getting 55%. That's why everybody went to bridge. They're all in trouble. Those still holding with bridge, they're going to be in a lot of trouble. Pay attention. There might be a quiz later. So the lender does whichever is lower for them. Okay. Loan to value or debt service coverage ratio. In the case of the way it's been in the last couple of years, it's been loan to value that's been lower, which is why they're only getting 55%. All right. That's probably the number one test that you can do. There's one other that isn't on here, and it's what's caused the oversupply in almost every market right now, and that is median household income. If you take median household income and you divide it by 12, that gets you median monthly household income. Property management companies, in order to qualify a renter for financial ability to pay the rent, they want to see 3 times the rent is their monthly income. So if I take median household income, I divide it by 12, and then I take that number and I divide it by 3 times the rent, that's the maximum rent that median of that market can handle. Now, what is median? Median's middle. That means half the people in the market can afford more and half the people in the market afford less. That's median. All right. Well, what have investors been doing? They have been completely ignoring median household income. And now rent affordability has gone so far out of control that all these units that are coming on for delivery at these really high rental rates, they are not able to rent those units because renters can no longer afford them. So now rental pricing has gone down. 3 straight months of rent decline across the country. Not every market, most markets.
Dave,
has nothing to do with tax, Tim.
is that based on zip code or metro area or
Market.
what's the qualifier?
That's market.
Okay.
And you can do it in the trade area to take a look at it, but that's primarily market. And it's before tax.
Okay.
So it's gross, your gross income.
I'm sorry, did you say before or after tax?
Before, it's gross income. All right. Any questions about underwriting? We're almost home. Last part, strategic partnering. So, what is a strategic partner? The dictionary definition says it's a company or organization that has an arrangement to work or help another so that it is easier for each one of them to achieve the things they want to achieve. So if we go back and we start with finding an off-market opportunity, and we find that opportunity, and then we underwrite it, and we say, okay, this truly is an opportunity. And we can now go out and build relationships, or we've been building relationships with syndicator sponsors, JV partners, people that are actually purchasing multifamily properties, knowing that we probably can't do it ourselves. We can now take that opportunity to them for an acquisition fee. That's the whole crux of all of this and why we're at this point right now. But there are other ways to be a strategic partner other than just acquisition, and we're going to cover that here in a second. So first, I want to start with the value proposition. What I did was I identified when I was a broker that I needed to separate myself from other brokers, and that's when I came up with strategic partner. So here was my value proposition to other syndicators and sponsors in the marketplace, where I was trying to build relationships with the people that were buying in the market. My problem as a broker, for all the years that I did it, I was a broker for 9 years. I never built relationships with the buyers. I always built relationships with the owners because I was always taught you list, you last. Well, that's good if you have a buyer's list. I didn't have a buyer's list. So that 560 million in off-market properties that I had found, and why I left brokerage for a little while, is because I sold 0 properties, none. I lost out, even at only 1% commission, I lost out on $5.5 million because I did not have the buyer relationships. So in January of 2021, I created strategic partnering. And this is how I went out to do it from about January to August. I'm looking to build strategic partnerships with active, established syndicator sponsors and key principals where I bring value of understanding, calculating, and identifying emerging markets, finding off-market opportunities, conducting market and feasibility analysis, expertise in due diligence and underwriting, and assisting in capital raising without taking a piece of the GP. And I'm looking to invest passively in the deals. Okay. And that's what I did. I wanted to take half of my commission or 80% of my commission, and I wanted to reinvest it as a passive investor in the deal. That was my goal on this. Okay. So what are the different roles you can be? Obviously, as a broker, I was doing acquisitions, deal flow. Okay. But I also obviously have experience in underwriting, market and feasibility analysis, demand and supply analysis. I actually teach those for the CCIM Institute. Capital raising. We've raised a little over $1 million with the company that we had in 2017, 2018. Then I left that company and decided I didn't want to do syndication anymore because I wasn't looking for a job. There's also project management, which during that syndication, I ended up being the project manager, the capital raiser, the underwriter, the acquisitions guy, the asset manager. All these roles I filled in that syndication, which is probably why I got a bad taste in my mouth from it. Then there's boots on the ground. So one of the really sought after things is somebody that lives in a market that's highly sought after. If you're willing to be boots on the ground to be able to learn, you can get involved in some syndication deals where you can receive some fees, maybe even a little percentage, where you can take that, and then I'll tell you what to do with it here in a little bit. So then there's asset manager, investor relations. Both of those can be interrelated. Again, boots on the ground could also be due diligence support, or you can have expertise in due diligence. Another thing I teach for the CCIM Institute is the strategic analysis model, which is due diligence. If you're a CPA, you can provide before acquisition, at acquisition operations and after sale tax strategies. If you're a JD, an attorney, and you're a contract expert, or you're a real estate expert or whatever, then you can be a strategic partner in syndications. Obviously, insurance brokers, mortgage brokers, and real estate brokers all can be great strategic partners to syndications to receive the fees that they normally receive anyway, where you're actually not taking from the passive investors. So what roles did I have inside my value proposition? Well, highlighted here, identifying emerging markets. That was one of my roles. Finding off-market opportunities, conducting market and feasibility analysis, due diligence and underwriting, and capital raising. Those were the roles that I identified in my value proposition. You guys kind of seeing how this is tying together? Okay, so how do you know what role you want to do? Obviously, the two that are really three that everybody defaults to are acquisitions, capital raising, and boots on the ground. But there is a way that you can figure out, and this was called the hedgehog concept from Jim Collins in Good to Great. I didn't create this. Okay, we all learn from other people. So using the hedgehog concept, what are you passionate about? Okay, which one of all those roles do you feel like you really want to do? I've got a very good friend of mine, a lot of you know him, Trevor Thompson. His passion is operations, which means he is best suited to be an asset manager. And that's his passion. Okay, what are you the best in the world at, or what can you become the best in the world at? And then is there demand for it? All right. So if we look at due diligence support, there might not be demand for that, even though that might be your passion, but there is demand for boots on the ground. So maybe you pimp yourself out as boots on the ground instead of due diligence support, but they can get extra value add service from you because you can provide that due diligence support as well. Okay. Always, always, always have continuous education on your passion so that you can become the best in the world at, and you really want to become valuable. So what value is in my value proposition? That's why it's called a value proposition. Emerging markets, being able to identify those are huge to syndicators. Off-market opportunities. How many people would drool right now for an off-market opportunity? Not taking a piece of the GP? What? I used to get asked all the time, why in the world do you want a piece of the GP? Okay, well, I don't want a job, dude. Okay, I just want to invest passively. Again, value to those syndicators. All right, you guys see how all that pieced together? All right, so how do we get our fees for being a strategic partner? So you can get a percentage of the GP. I don't recommend it, but if you are wanting to build a large multifamily company in the future that owns thousands of units and has hundreds of employees all across the country, you have to go through the syndication process. You don't have a choice. It's a rung on a ladder. It is what it is. The lenders require it. Operating partners require it. Capital partners require it. It is what it is. In that case, you probably are going to go with the percentage of the GP. Percentage of the acquisition fee. That's what I like to do. So I can take that fee and then I can do something with it. And I'll cover that in a minute. You can get a percentage of the asset management fee if you are dealing with the investors as investor relations or asset management. Now, don't make the mistake of thinking because you bring the deal, you get the whole acquisition fee. That isn't going to happen. You'll get a percentage of it. Your negotiating skills will determine on how much of a percentage. Same with the asset management fee. I guarantee you the primary sponsor, whether they're the asset manager or not, is going to get a piece of that asset management fee. If you are brought on as an asset manager, you will get a percentage of it. You will not get all of it. And it isn't that much anyway. You can get a consulting fee. That's what I like to tell you. Even if it's going to be an acquisition fee, on the HUD, you want to make sure that you or your company is on the HUD as a consultant so that you can get paid at closing. Do not ever require or allow the buyer to pay you. Chances are you're not going to get paid even if you have a contract. Okay, get a loan broker fee. That goes without saying. Real estate broker fee, insurance broker fee. These are all the ways we can get paid. But what do we do with our fee once we have it? Okay, here's where the rubber meets the road. It depends on your goals. If you need quick cash, okay, so that means you just need the fee and you're going to take it and you're going to do, maybe you got bills to pay or you need debt to pay down or you're behind on your mortgage and you got to catch your mortgage up, whatever that is. Quick cash just means that it's intermittent, means you got to have every time you need cash, you need to have another type of fee in order to get that cash. It's intermittent. Then there's cash flow. Okay, that's consistent. So you got a piece of that GP, or maybe you're a JV partner on something. You've got consistent cash flow coming in if the general partners are doing what they're supposed to do. Most haven't recently, but that's beside the point. And then there's wealth building, which is also consistent. So if you were to take that fee and put it back into the deal as a passive investor, and you're receiving those preferred returns every quarter, that is consistent cash flow. All right. So it depends on your goals, which you do with your fee. So the first thing you can do, if it's intermittent, you're going to bring it to the house. Okay. If you bring it to the house, you're going to pay the tax man the most. Okay. Or you can reinvest up to 80%, which is what I did, either into the deal or partner with one or two more other people that have equal or more money than you have, and go buy a smaller property where the three of you are joint venturing on the deal. Okay. This is how we pay the tax man the least. So how do we become a strategic partner? Well, you must build relationships. Relationships. Okay. The first three words in real estate are not location, 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 because without relationships, the location is irrelevant. You've got to find off-market opportunities. You need to underwrite the deal, win strategic partnering assignments from the relationships that you've built, and collect your acquisition fee.